In this video, I'll be revealing Vanguard's highest paying dividend ETFs. If you're looking to start investing in 2025 or you're currently reassessing your investment portfolio, this is the video for you. We'll be covering everything that you need to know. Dividends, of course, are great as they allow you to earn a passive income with money dropping into your pocket as often as 4 times a year. You can use this money to upgrade your lifestyle or reinvest to compound your returns over time. Make sure to stay tuned as every ETF offers something unique, increasing your income and diversification potential. Vanguard ETFs are renowned for their low management fees and long-term performance, making them a favorite among cost-conscious investors. They are Australia's largest issuer of ETFs, with over $61 billion invested in Australia alone. This makes them more than 50% larger than Betashares in second place. This also gives them a market share of over 28% in Australia. Globally, they manage over $10 trillion with a T. So they know their stuff and will be the exclusive focus for this video. Of 27 ETFs currently offered in the market, I've narrowed down the top 8 for this video as of the 8th of December 2024. Let's kick off with Vanguard's Ethically Conscious Australian Shares ETF, ticker VETH. As the name suggests, this ETF caters to ethically conscious investors. It offers exposure to Australian companies while excluding those involved in industries like fossil fuels, nuclear power, alcohol, tobacco, gambling, and weapons. It also avoids companies with severe controversies or ESG concerns. This makes it a great option for investors looking to align their portfolio with their values. With over $500 million invested and a competitive management fee of 0.16%, VETH is accessible and affordable. It provides quarterly distributions with a dividend yield of 2.95%, reflecting its focus on growth-oriented yet responsible investments. Launched in 2020, it's relatively new, but has already gained traction among ESG-conscious investors. While VETH aligns with ethical investing principles, its exclusions may limit diversification and lead to underperformance in certain sectors, like energy. It may therefore be best suited for investors prioritizing sustainability over all else. Moving along, in 7th spot we have Vanguard's Australian Corporate Fixed Interest Index ETF, ticker VACF. This ETF offers exposure to around 400 Australian corporate bonds, focusing on investment-grade credit securities. Issuers include Australia's 4 major banks, large industrial companies, and global companies issuing bonds in Australia. It's a low-risk option, making it ideal for conservative investors or those looking to balance equity-heavy portfolios with fixed income assets. With over $650 million invested and a management fee of 0.2%, VACF is cost-effective for bond investing. Its quarterly dividend yield is 3.07%, offering a stable income stream. Since its inception in 2016, it has been a reliable performer, particularly during periods of market volatility when bonds tend to act as a safe haven. The ETF may suit investors prioritizing capital preservation and predictable returns. However, it is sensitive to interest rate changes, which can impact bond prices inversely. Its low risk and stable income make it an important part of a diversified portfolio. In 6th spot, we have Vanguard's Diversified High Growth Index ETF, ticker VDHG. This ETF is a one-stop solution for growth-focused investors, offering a diversified portfolio with around 90% growth assets like shares and 10% income-producing assets like bonds. Its balanced structure makes it suitable for long-term investors seeking higher returns while maintaining some income stability. With over $2.5 billion under management and a management fee of 0.27%, VDHG is slightly costlier but offers convenience and a robust mix of assets. Its quarterly dividend yield is 3.1%, appealing to those who want income alongside capital growth. Launched in 2017, VDHG has gained popularity for its simplicity and effectiveness. Although it is diversified across asset classes, its heavy tilt towards equities may result in higher volatility, making it less suitable for risk-averse investors. For those with a longer investment horizon, VDHG might be worth looking into. Up 5th, we have Vanguard's MSCI Australian Large Companies Index ETF, ticker VLC. This ETF tracks the MSCI Australian Large Companies Index, offering exposure to 20 or so of Australia's largest and most established companies. With a relatively modest $260 million invested and a management fee of 0.2%, VLC offers a quick solution to investing in Australia's market leaders. The fund's top holdings include industry heavyweights like BHP and CSL, and of course the major banks, among others. The ETF delivers a dividend yield of 3.1% with quarterly distributions. Launched in 2011, VLC suits investors who prefer blue-chip stocks and a straightforward investment strategy of just taking the 20 or so largest stocks. While the dividend yield is attractive, its narrow focus on large-cap companies means less diversification compared to broader market ETFs. Investors that want the stability and dependability of Australia's most dominant companies may find this ETF suitable for their portfolio. Now we're up to number 4, with Vanguard's largest ETF, the Australian Shares Index ETF, ticker VAS. This ETF offers comprehensive exposure to the top 300 or so companies listed on the ASX. With a massive $16.8 billion in assets under management and a low management fee of 0.07%, this ETF is ideal for long-term investors seeking to mirror the performance of the Australian stock market. Key sectors for the ETF include financials, materials, and healthcare, with companies like BHP, Commonwealth Bank, and CSL as major holdings. VAS delivers dividends quarterly, making it attractive to income-focused investors. It currently pays a dividend yield of 3.12%, backed by a consistent track record since the inception in 2009. Its affordability, high liquidity, and exposure to a diversified portfolio of established companies makes VAS a cornerstone investment for Australian investors. However, the Australian stock market leans heavily towards the financials and materials sectors. So with concern for diversification, it may be worthwhile partnering it with another ETF with less exposure to these sectors. In the bronze position, we have Vanguard's Australian Property Securities Index ETF, ticker VAP. The ETF provides exposure to a diversified mix of Australian real estate investment trusts covering residential, office, retail, and industrial properties. This fund is perfect for investors seeking dividend income from property without directly owning real estate itself. With over $3 billion invested and a management fee of 0.23%, VAP offers quarterly distributions and a dividend yield of 3.86%. Its portfolio includes well-known real estate investment trusts such as Goodman, Centre, and GPT Groups. Established in 2010, VAP has built a reputation for steady payouts. While real estate is known for resilience, the ETF may face headwinds during periods of high interest rates. This could impact property valuations and therefore yields. However, for long-term investors, VAP provides a simple and diversified route to real estate exposure. Now we're up to the silver position, occupied by Vanguard's MSCI Index International Shares Hedged ETF, ticker VGAD. This ETF offers access to over 1,500 companies in developed markets outside of Australia. It also has currency hedging to minimize exchange rate volatility. This ETF is ideal for investors seeking global diversification without the risk of fluctuating foreign currencies impacting its returns. Its non-hedged version is Vanguard's second largest ETF with roughly $9 billion invested. The hedged version, on the other hand, has about $3.6 billion invested and a management fee of 0.21%. Key holdings include Apple, Nvidia, and Microsoft, representing sectors such as technology, healthcare, and consumer goods. Over the past year, VGAD paid a dividend yield of 4.34%. However, it comes with a massive hook. Up until the latest distribution in June, the previous dividend was paid 2 years prior. So technically, based on a trailing 12-month period, its yield looks great. But if we look back, it doesn't look like a reliable dividend payer. The unhedged version of the fund came in as the 10th highest dividend payer, with regular quarterly dividend payments, as you can see here. Now we've reached our gold position, the top dividend payer in Vanguard's ETF suite of products. To nobody's surprise, given its name, it's the Vanguard Australian Shares High Yield ETF, ticker VHY. This ETF is specifically designed for investors seeking higher yields than the broader Australian market. It focuses on high dividend-paying companies with its top holdings including major banks and resource giants. Its management fee is slightly higher at 0.25%, justified by its targeted strategy. With over $4.2 billion under management, VHY provides quarterly distributions and a standout dividend yield of 5.21%. This is by a large margin the highest paying dividend ETF on this list. It is of course ideal for those prioritizing income with a particular interest in Australian stocks exclusively. Launched in 2011, it has been around for a while. Vanguard put guardrails around its diversification as well, limiting any one sector to 40% and any one company to 10%. This ensures that the ETF is reasonably diversified and isn't backing just a couple names with high yields. Currently, there are 69 holdings, with financials passing this 40% threshold, but likely to be trimmed at the next rebalancing cycle. If you want to check out Australia's top dividend stocks, make sure to check out these videos that should be appearing somewhere over here. I scanned all of the available options, so you're sure to find some gems in there. Don't forget to subscribe, and I look forward to catching you on the next one. Cheers.